So we've seen implied correlation levels come down really hard. We've seen realized volatility levels drop significantly. And we're at a point of the season now where we're going into earnings and we should really start seeing volatility expand. We've passed option expiration and we've hit really low levels on realized volatility, really low levels on implied correlations, and we start seeing these things expand. And that means that the market here at these levels is probably susceptible to some sort of pullback, perhaps similar to what we saw in the summer of 2023 or even the summer of 2024. Actually, the summer of 2023 saw a steeper decline, but the summer of 24 was more violent and happened in a much quicker way. Please remember to support me by subscribing to this channel, sharing it with your friends, leaving a comment, and we're trying to revamp and get the routine moving again. And so when we kind of think about why that is, again, if you're a member of the channel, you probably already know this because we've been talking about it for some time, the volatility dispersion trade. And if you saw the video from earlier in the week, we kind of went through the intro idea of it. But if this is the first time watching it, I'm going to try to explain it and go through this. So basically, what we've seen in the S&P 500 more recently is what's called vol suppression. Generally speaking, about a month before a company reports results, we start seeing these cycles in the market where implied volatility for the underlying stock begins to go higher in anticipation of the event, while the S&P 500 implied volatility will usually stay either flat or will fall and will go down. And this is part of a trade called volatility dispersion. And so the idea here is that you go long the individual stock's volatility, however it is that you choose to do that, and at the same time you go short index volatility, again, however it is you decide to do that. We're not getting into the mechanics of the trade itself, but how the trade works. And typically you can see that here with Meta. We saw this in September of 24. Implied volatility back around the middle of September starts going higher. It peaks right into October 30th, right around the time the company reports. Once the company reports results, implied volatility comes down sharply, and the cycle repeats going into January 29th. And then, of course, we had the blow up in April. So things didn't quite work the same, but you can see right here around April 14th, implied volatility for Meta started going up until it reported results and then came down sharply. And then right here around June 18th, same process begins. So it's always about a month before. Generally speaking, in most of these bigger mega cap names, it's about a month before you see the earnings come out. And at that period of time, you'll see implied volatility for Meta going higher, and you see at the same time implied volatility was basically flat for the S&P. We had some move up, but there were things going on in the market, such as the election during that period of time. But if you look in and zoom more towards this time of year, you can clearly see that S&P 500 and Meta volatility both going lower until about middle of June, and then they began to really separate. Volatility of the S&P starts going down, implied volatility of the Meta starts going up, and on the bottom what you get is the correlation between the implied volatility levels, and the implied volatility levels goes from being positive, almost a nearly perfect +1, to almost a completely inverted negative 0.73. And again, this cycle repeats. And then once you get to past earnings and volatility of Meta starts coming down, that starts pushing the implied correlation higher and back towards zero and positive. And so when you look at it more on an individual basis, you can see on these stocks basically the same pattern really persists. If we just remove Tesla because it's been acting a little odd lately, you can generally see across the Mag 6, then you can see that pattern pretty much presents itself and repeats. Actually, there's only 5 here. I've excluded NVIDIA because NVIDIA obviously reports much later in the quarter. So you'll see that when I add it in, it tends to work off of a slightly different cycle. If you want to track this, you can track this really by looking at the 1-month implied correlation index. Basically, this index measures the top 50 stocks in the S&P 500 and their implied volatility levels and how they correlate to the S&P 500. And typically, again, when this value is falling, it implies that the correlations in the S&P, the individual stock components, are not correlated with, or they're trading independently of the S&P 500 implied volatility levels. And typically when you see this correlation go negative, going down, going lower, become more dispersed, you're seeing stock prices rise. And then when you start seeing the correlation begin to rise again, you're seeing that the S&P 500 comes down because the trade is in the process of unwinding. Notice that correlations went much higher into October 30th, 2023. Then they started coming down. You saw the big move up. Equity prices, you saw correlations come up again. Stocks came down, big move down in correlations. You got that big run up into August of 24. Correlations really exploded very quickly because of what happened in Japan and what was going on here in August of 24. And then when they came down, you could see the market rallied. And then and also interestingly, the timing of the meltdown in February, March, and April corresponded with earnings season as well. And so we're kind of at that point where, again, we should really start seeing implied correlations beginning to go higher as implied volatility levels begin to trade with one another. So it's not really, by chance that when the S&P 500 is rising, implied correlations should be going down, and when the S&P 500 is falling, implied correlations should be going up. And so if you start seeing scenarios where, like you've started to see a little bit more recently, where implied correlations are kind of trending higher with the equity market, that's not really something that you really should be seeing very often. It can happen, but again, it's not something we generally tend to see. And so we've seen, as of right now, at least July 10th so far has marked the low in implied correlations, and there's reason to believe that continues, just because we've seen the implied correlations on individual stocks, the top 5 or 6 names, at least begin to rise. And so since you've already started to get earnings out of some of the big banks, you're already seeing implied correlations already begin to unwind. The other thing, obviously, is that realized volatility is also very low. Very similarly, if we take out the 3-month realized volatility and we take out 10-month realized volatility and look solely at 21-day realized vol, which is basically 1 month, what you see here is that realized vol bottomed on August 1st in 23, realized vol bottomed on July 9th of 24, and right now we're basically back to the 7.5, which is right around where we've been in previous lows. Notice here, end of December, that was around the time of the Fed meeting. Realized vol bottomed, and then we got that little mini blip into end of December into January. Realized vol never got quite that low again in February, but then obviously we had the events of April. Right now, realized vol on a 1-month basis is very low. It's kind of at the very low end of the range, historically speaking. And typically when you start getting to realized volatility this low, it basically tells you that realized volatility is bound to rise, because if you take a number of 7.5 and then you divide that by 16, which annualizes the volatility, it basically means that the S&P 500 has to trade within 45 to 50 basis points per day. It has to really trade less than 45 basis points per day to keep getting this number to go lower. And that becomes harder and harder, obviously, because eventually at some point you do get that shock. And remember, realized vol works either up or down. So we're not talking about only 45 basis points down. We're talking about 45 basis points up or down. And so, again, if you look at the S&P, at least over the last, week or two, going back all the way to July 3rd, you had an 83 basis point move, then 80 basis points, 7 basis points, 61, 27, 33, 14, 40, 32, 54, 1. So, basically since, July 8th, realized volatility has really been compressing. And that's what's really driving it down at this point. Again, it could persist for a couple more days. We could see a couple more days of grinding action. We might even get a little bit of a blip higher. But again, generally speaking, we're kind of at a range here where we're likely to see volatility begin to really expand. And once realized volatility starts to go up, you tend to see implied volatility goes up. So here's the VIX. And so generally speaking, we see these two trade together. Implied volatility, in theory, should be anticipating a rise in realized vol. So basically, again, what you're kind of seeing here is that once the market begins to sense that realized vol is probably as low as it's going to get, you start to see things like the VVIX moving up, which you can clearly see it's been in an uptrend now for a couple of days, really since July 3rd. Although it's not really significantly higher, it's, you know, basically been trending higher. And notice we were even higher on Friday. So generally speaking, to know when the market is sort of running out of steam at this point, what you'll notice is on a daily basis, VVIX should start going up. The VIX should really start going up. You should start seeing implied correlations going up, and that eventually will tell you that the S&P 500, if it isn't going down or going down significantly, that turn should be coming. Nothing, of course, is guaranteed, but again, what this is implying is that turn is likely to be coming. The other factor that we're, you know, kind of confronted with right now is that we've just passed option expiration, and so we've had some vol compression and compression in the marketplace, mostly because we've also been pinned to around 6250 to 6300, which were pretty key gamma levels for the marketplace. And now those gamma levels will be quote unquote unpinned starting when we return to trade on Monday. So we could see that range really expand some in the next couple of days. In fact, we've done this before, actually, where we've looked at this and notice that if you notice, these turns have come around option expiration. So option expiration, OPEX came March 14th, March 21st. Then, of course, we had the April OPEX here. And if you go out to May, here's your May OPEX. We came down a little bit, basically led to sideways consolidation. Then we had June OPEX, which was on the 20th. And then, of course, the market began to move higher. And so now we are here. So we've had basically two option expirations in a row where the market bottomed in this case and then turned higher. Then we went sideways, and then once we passed OPEX, we went higher. So again, I don't know how it will play out, but given the dynamics, we know that OPEX can tend to be a turning point for the market. It has been more recently. And so if one were to guess, given the realized volatility, implied correlations, and knowing that where we are in terms of the seasonality of the marketplace, one would think that if there is going to be a turn, there could be one, probably starting later this week. And we could have a decent correction. It's hard to say exactly how much. We obviously would need to see the index really break below the 10-day exponential moving average. And once that happens and it kind of confirms it, you could start looking for gap fills down to 6,000 and maybe even lower than that, just because the market has really gone up on low trading volumes and low liquidity levels. And it's really been, an NVIDIA sort of driven marketplace. And once the market unpins, things could really start, moving. So we'll, be here to stay on top of everything. I hope you found this helpful. And please remember to subscribe to this channel, like this video, share with your friends, and we'll see you again soon.